We are going to take a look at a case study in this video and see how an individual utilized whole life insurance, how it fit into his specific plan. We're going to see how it helped him in the here and now as he looked at a large policy. But really what we're going to examine in this case study is what his financial picture looked like in his path from age 49, which is when we met him, when he started the plan, up until age 65, and then also in retirement. What did things look like before he worked with us and looked at cash value life insurance? And then how did his plan change if he decided to move some of his assets into a policy and then see everything side by side? Here's my current path, and did cash value life insurance enhance my overall strategy, or did it weaken it? Did it make it inferior? Seeing that provides a lot of certainty to see, hey, is this a plan for me, or did it not work out? And he was specifically interested, or I should say is specifically interested in using the money now and then also long-term during retirement. To set a little bit of background or provide a little background on this case, this was a case with someone that we started working with, I did personally, back in 2016. He executed or implemented the policy shortly after I got married. So when I met him, when he started this policy, he was 49. Now, 6 years later, we're going to look at how that policy is actually performing at the end of this case study, which will be really neat to see. When we've got that question, does whole life insurance actually work? Because we may see models that look good on paper, but what's it actually look like in terms of real performance? We're gonna see just that. We're gonna have a lot of fun with this. So first things first, let's look at the details of this case. Age 49, his wife is also 49, 3 kids ranging from age 15 through 25. Annual income, $225,000. He also recently started getting into real estate. Not so recently, but he's starting to pick up the pace, really build that portfolio up. Rental income right now is at $35,000 per year. He also recently sold a piece of property. This was back in 2016. And has a net of $180,000 coming in cash, although it is not received yet, so we did not include it on this balance sheet. Net worth, about $1.55 million, consisting of home, $615,000. He's got his rental properties. Presently, he has 4 of them, again, back in 2016, valued at $770,000. A lot of money in cash, $425,000. And that excludes the 180 that's coming in. So he's a cash cow. He's not a stock market guy. You'll see underneath cash, his taxable investments, stocks, bonds, mutual funds, $50,000. He puts very little there because it's not his thing. He's looked at it several times, puts a little bit of money there, but it's gotta be money that he doesn't care to look at or think about, just not his thing personally. Some do very well there, really a matter of preference, in my opinion. Qualified accounts, has about $460,000 there. Those are 401ks, old IRAs, also has a self-directed IRA in there as well. But that is his qualified money presently. And then he does have some debts. We see $335,000 on his primary mortgage, $400,000, that's the total balance combined of his 4 rental properties, and then also 2 small car loans, and we've got his cash flow going toward the debt as well. I'll add, when we actually build these plans out or work with individuals, it is much more in-depth than what you will see on this case study, because we want to really break it or break down the numbers, see where the cash flow is going if someone wants that. So let's continue on here. Here's what he's got going on in terms of savings. So he pulls in $225,000 per year. That's his salary. He has the rental income at $35,000, but if we look at the amount of money going toward those rentals, $36,000 per year, a wash there. And he's got property tax as well. However, he is getting to the point where he's starting to cash flow. He was positive, but he sold a piece of property for $180,000 that's coming in. That's going to add to the net worth. Right now, he saves annually a little over $40,000 per year, $42,000 per year. He also just started saving money in his 401k at a company he's with, $13,500. He receives a match of $66,750. So that is what he is saving systematically, going into cash because he doesn't want to put it into the market. Really what he does with cash, to be clear here, is he does look at real estate opportunities. That's why he stockpiles that cash so he can heavily invest in real estate and not have to leverage a large amount. He likes putting cash down. Now he's got some cash coming in. So deferred compensation plan. He has put his time in at work. You ever feel like that? You're going. Should I stay with this company? I've had it, but I've got this reward at the end of the road. He made it. This is back in 2016 again, where he received news he was finally going to receive his deferred compensation plan for a gross payment of $385,000 per year for the next 4 years. So $385,000 per year for 4 years. He put his time in. He earned this. He's a very, very sharp guy. Still have a great relationship with him. I love talking to him. Great ideas always come from him. $225,000, he's underpaid just from talking to him, like what he's able to produce, but he put his time in for that, the deferred comp plan. Now, what we calculated here is he is going to be taxed on that money. So we ran the tax bracket or the tax assumption at 30%. May not be quite that high at the end of the day, but we always like to shoot it a bit more conservatively. Let's pull out 30%, and if you have more left over, you're happy. If I say let's calculate it at 20 or 25%, and then it is 30%, you don't like me that much. So let's run it conservative, and if we have more left over at the end of the day, that's great. So that'll net him with $270,000 per year for the next 4 years. Total payments received, $1.54 million. Now again, if we back out the 30% tax, $460,000, that is a bite, but he nets out a little over $1 million after tax. Guess where that's going? Cash, and then going to be used for real estate because that's his thing. Now I'll add a little bit, fast forwarding today to today, 2021, he is involved in startup companies, side projects. He's doing much more, but the real estate, that's his thing. Aside from his annual salary at his company, the real estate is really what's building his net worth, and you're going to see that as we progress through this plan. So, property sale, more cash coming in, $180,000. He does have a 20-year term policy for $500,000 in life insurance, but that's it. That's what he has presently. Let's continue on. So what we're going to look at here is his current plan accumulation, meaning as the money grows, by age 65, what will he have if he just stays on the current path he's presently on? So what we're going to look at here is different growth assumptions. We're going to begin with the qualified money, the taxable account. So he has $513,000, and to be clear here, when I say qualified and taxable, I mean the qualified accounts here of $463,000, and then the taxable investments of $50,000. Add the two together, we've got that $513,000. He also is saving, or a total input is $20,250. Where that comes from is these two areas. I'm sorry, not the cash. Comes from this area. The 401k, he's paying $13,500, company match of $6,750, savings toward the qualified account, $20,250. So what we want to know here is based on the present balance of $513 and him paying $20,250, what will it grow to by age 65? Let's take a look here. So let's look at an assumption. Got our software from 1982. We had $513 in the balance, funding $20,250 from age 49 through age 65. So we're going to plug in 16 years. Now, I'll add, in the actual plan, when we forecast these models, we do like to look at very conservative rates. So we looked at a 3 and 4% rate, 5 and 6, and also a 7% rate. Now, this is his money that I don't want to say he doesn't care about, but again, more of it's tied to the market where he says, hey, it's in there. I'm not really paying attention to it because I don't want to pay attention to it. Otherwise, I just look at it all the time. At least that's how I feel with that kind of stuff. So I've got it there. Let it grow. We are going to run it at a 7% assumption. Personally, I think that's aggressive because I like to shoot it conservative. But for this model, for the client and looking at different options as well, we're going to look at 7%. And normally, we would kick that down to 4 or 5%. Because again, if we project 4 or 5 and it works, but then we do 7, we're great. If we're expecting 7 and we don't do 7, we're not that great. But here we go. About $2,120,000. So 2.12, let's call it. Let's just round. Okay, so that is the qualified account balance by age 65. Next, let's look at cash and savings. So we're going to run a 1% assumption on this. That's a bit aggressive nowadays, even at that, maybe 0.1%. But as we run this model, I just want to be a little realistic. He's not going to just stockpile cash forever. A lot of people do, believe it or not, because it is safe. They don't have to think about it. It's there if they need it for anything. That's the advantage to cash. But realistically, he's not just going to keep pumping this money into a bank account and let it sit in his bank account. He's using it for real estate, and we'll see that in the next bullet point. For the sake of the model, though, in case you are saving a lot of money in cash, we've got $425 in cash savings right now, saving $42,000 per year through age 65. But then also, we've got $270. That comes from the net amount after tax from the deferred compensation payments of $270 per year for a period of 4 years. And then also has the property sale of $180,000. So we want to model this now at 1%. And we can model this at different rates too, because if you're in a position where you are looking for planning right now to see different models, you might be in a similar situation to this, but the money just is not in cash. You're saving it somewhere else. And that's where we look at different assumptions. So let's take a look here. 425 presently. And we've got the different figures. 42, 270, 180. Okay. 425 present value. Paying in $42,000 per year for a period of 16 years. 1%. We can't run something more aggressive. However, we have to factor in the additional payments. So year 1, he's got the 42 going in, but he also has what going in? The 180 from the property sale, which he's likely going to reinvest in additional real estate, but then also the 270 from the deferred compensation. That's the net after tax amount. So what we've got here is 492 that will go in, I should say that did go in, since we met with him back in 2016. I gotta check the exact cash balances, but I know he quickly invested heavily in real estate. 42,000 plus next year, just the 270, 312. Let me just see something real quick here. Perfect. 312. And this is the kind of stuff we want to do. Make sure the numbers are accurate. So here's what he's looking to do. 492, 312, and then 42,000 per year. That's what he's saving and has consistently been doing. Just about $2.7 million in total cash. Okay. And again, if you're putting it elsewhere, you say, hey, I'm not putting that kind of money in cash, and I don't do real estate. So what would it look like, Steve, if you ran that model at 4% or 5%? What does the balance change to? And then again, in reality, we want to make sure we adjust each year accordingly as well. That's just taking it a step further, which here we're looking at more of what he did. So the 2.69, let's call it. Okay. And then he has a total real estate value of $1.385 million. Now, if we run that appreciation at 4% per year from now, or age 49 until age 65, so a period of 16 years, that will grow just to about 2.6 million. Now, that's a bit conservative because he's not just holding that and letting it sit and grow. He's actively increasing the value, acquiring more property. He's an active real estate investor. So what we looked at is based on his personal belief and his personal potential. If you've ever felt like that, hey, I'm going to increase it by more than just the appreciation, we're going to assume by age 65, he's got his real estate values at $4 million. And again, we can make this number anything we want, but this is where a conversation certainly comes into play, where we've got all the formulas, the calculators to say, hey, here's what it can grow to, but what's the human factor? What can I actually produce? What do I know I can do if I, based on my present production results, my present potential, if I shoot it conservative, or if I know I'm going to continue to improve my skill set. But that gets me excited, so I'm going to stop talking there and get back on track here. So it's personal belief of this individual, $4 million growth. You could probably do more, actually. And the personal belief is hypothetical. What I mean when I say that is me saying, hey, here's what we believe you can do. Let's continue on here. Rental income at 4.5%. So rental income at 4.5%. That'll likely increase as well, but we're basing it off of his current rent rate, meaning his rental property is at $770. If we were to run the math based on that $35,000 per year, 4.5% is what they're producing as far as what he actually receives in total rents. Will he raise that over time? Most likely. However, again, shooting things conservative here, we just ran it at 4.5%. And what we've got here is based on the 2.6. That'll generate $117,000 in rental income per year. And based on the $4 million, since he's going to use this cash that he's just stockpiling at the $4,180,000. So this gives a nice picture of what he will grow his net worth to at the present pace. So let's take a look here. We've got the 2.21 million or 12 million, 2.69 and 4. 2120 plus 2960 plus the $4 million real estate. At age 65, you've got the 8810. All right, let's get back on track here. 8810. I like the screen. It reminds me of Tony Stark. Tony Stark was able to build this in a cave with a box of scraps. I'll stop referencing movies now. So, on his current path, he will grow to almost $9 million in net worth, and he has been growing quickly over the past 5-6 years that I've known him, really because he's starting to move at a nice pace, and he had this big cash infusion, this deferred comp money really that came in, that he is actively using in his other businesses, the side projects, real estate, and he's growing quickly. Put his time in to get the deferred comp, got the money, and he put it to use really in himself. So now we want to see, based on his present path, what will this produce in terms of income by age 65, and you'll see he's going to be fine with or without me. He knows what he's doing, or with or without us in our strategy, I should say, or anyone. But also, what's it look like if we do implement cash value life insurance? Can it actually help him? Can it enhance his situation? That's the question. So let's take a look. Based on his current plan, what do we have here? Present net worth, 1.55 million. What do we see as time passes? I'm going to correct this total age 65 net worth, but what do we got? Cash, 425. There's your savings, 42,000 per year towards cash, but you also have that 1.26 million going in, which was the deferred comp payments over 4 years, and also the property sale. Granted, this is going to be used for real estate. I just want to reiterate that several times because stockpiling that much cash, some people do it, but I mean, we're using it for opportunities. That's really what cash is for. So investments, 463, and those investments include the 50,000 in taxable investments that he has access to, but also the qualified accounts, that $463,000 in IRAs and 401ks. Savings, a little over 20 grand per year, combination of his actual savings, and then also we've got the company match. Real estate, a little under 1.4 million. Investments, we've got the 2,080,000. What that is based on, was my math slightly off, the 2.12 million. Let's correct that. then also the real estate at $4 million. Now, if we are stockpiling cash, because again, some people we've run into do this, what he may look at, or what anyone might look at, is one of the two following. At age 65, I'm no longer working. I can put that into an annuity to guarantee income stream. I can just spend the cash down, or I could look at real estate. Maybe it's a real estate syndication deal that produces consistent monthly income, passive, where I don't have to think about it or actively work on it, unless that's my thing. So let's start to analyze things here. That is his current plan. We want to compare that with an alternate plan. And here's what the alternate plan consists of. So again, he's doing very well for himself. He doesn't need us. The question is, how does cash value life insurance enhance my present position? And he came in saying, hey, I don't really care about the death benefit. I feel like the $500K in death benefit's enough. I've got $400,000 plus in cash. I've got these deferred comp plans. Like, I'm good. My family's good. We're okay. I don't care about the death benefit. The cash value, that's what I'm interested in from what I've heard about it. I've heard a lot of these wealthy individuals doing it for cash value, and there's a long-term legacy plan, but the cash is what I'm interested in, Steve. All right. So what we're going to look at here is redirecting some of his cash toward a high cash value life insurance policy. When I say cash payments, specifically what I mean here is a portion of the deferred comp payments he's receiving. That's exactly what we did. So high cash value policy. Here is what we are going to look at here. $150,000 per year, years 1 through 7, nothing thereafter. Now, he might decide to continue to pay into it at $50,000 per year through age 65. But he doesn't want to commit to that. He doesn't even want to commit to the $150 per year for 7 years. That's a total of a little over $1 million going into the policy. You are going to see when we look at the actual policy at the end of this, how he pivoted his actual funding course. So it'll be interesting to see how you can actually do that. When I start a policy, am I locked into that plan? No, not by any means. But here's what we want to look at next. So the $150 for 7 years. Could he go more aggressive than this? Definitely, with the amount of cash that he has stockpiled over here and that's incoming. But he's learning about it. And he said, you know what? This is what I'm comfortable with now. After a lot of back and forth, this is what I want to do. If I really, really love it, I might get more or continue to pay into this. But that's the number, having the ability, I want to emphasize this word, ability to pay up to $150,000 per year for 7 years and longer if he wanted to, if he decides to. So again, could have allocated more money there, but what happened here is he used a lot of that cash for real estate and the debt that he had. This way he can wipe it out and clear it if he wants to. So let's take a look here at the policy first. What I want to touch on is the policy design. So how is this policy constructed? Because conceptually, we're going through how the plan works. We're looking at his other numbers. This is a crucial part of the plan. When we look at the actual cash value life insurance policy, the design, meaning when I set it up, my money can go toward the base premium or into PUAs. Designing it properly ensures that I will have a cash-rich policy from day one. The majority of what I pay in will be in cash value. It'll be very flexible, so I'm only committed to the minimum. And also I want to make sure I'm looking at one of the top companies in the industry that have a track record of actually delivering strong cash values, not just projecting them, and then I'm disappointed as a consumer. So here's what we're going to look at. We've got an illustration up here. $150,000 per year for 7 years. We've got a simplified version on Excel, but here's what I want to go through first. Anytime we look at a life insurance illustration, my question is, where is the money going? That is the key indicator to know if a policy is designed for maximum cash value. So if you're looking at a policy, maybe for long-term death benefit planning, but the cash value is your point of interest, knowing what to look for. How do I identify this? If you're not working with us, here's what to look for. So here's his funding, $150,000 per year going into the policy. So of that $150,000, my money can go where? I can allocate it toward the premium. What happens with the premium in the first and second year of a life insurance policy? About nothing shows up in cash value. Here is my premium, $15,000, exactly 10% of the total payment. So this does a couple things for me. One, with this company, the lowest I can drive that premium is 10% of the total desired payment. So if I want the ability to go up to $150, the insurance company will say, okay, wherever you set your premium, you can pay 10x that. So if you have a $5,000 premium, we're not going to let you pay more than $50,000 per year into the policy. So $15,000 premium. We also have a PUA component of $135 going into a policy. Now there's a term rider attached here as well. We've got other videos on that which provide a lot of transparency on how that works. I'm not going to get into those details in this video. But the insurance company limit. So they will allow a maximum of a 10/90 split. 10% premium, 90% PUA. That gives me a ton of flexibility as well, where I'm only committed to the $15,000 figure. So now I can commit to a minimal amount and add more funds, whether it's one time per year, at my discretion. That depends on the insurance company and their flexibility features, which we've got a lot of technical content on that. And it's difficult for me not to go into every detail on every video we do because I'm a nerd. So, insurance company allows me to 10x my minimum base premium. Here's the other thing I want to look at. That death benefit. He says, I don't care about the death benefit. Not initially, it's not my goal. $4.35 million. The other limit I want to be aware of with a life insurance policy is an IRS limit, which is my Mech Limit, stands for Modified Endowment Contract. The core benefits to a cash value life insurance, this is a critical part of the video, critical piece of information, core benefits of a cash value life insurance policy is if I do everything properly, it is a safe, liquid, tax-free area to position money. Now with that said, any life insurance policy can become classified as a MEC, a Modified Endowment Contract. If it does, my life insurance policy, the death benefit's still tax-free, but the cash value, it grows tax deferred. Anything I access in respect to the gains, I have to deal with ordinary income tax and a potential 10% penalty tax. I don't want it. Not attractive at all. So how we prevent it is every policy has what is called a Mech Limit. You'll find that Mech Limit right here. That Mech Limit has a direct relationship to an individual's age and total death benefit on a life insurance policy. That is the measuring stick the IRS uses to determine if that policy is life insurance in their eyes or a pure taxable investment. So my point here is, going back to the death benefit, he says, hey, the death benefit, I don't care about it. Why do we need $4.35 million? Isn't that expensive? So why we need that is that obtains that Mech limit of $150,000, meaning we purchase the minimum amount of insurance possible in order to obtain a $150K Mech limit so you could plow money into the policy as you desire. What we also did was reduce the insurance expenses, $15,000 minimum premium, added a term rider for several $100s per year, which is a cheap way to get that death benefit up and get more money toward cash value. A lot of info here. Our policy design videos provide a lot more information on that piece, but hopefully that helped just conceptually understand how this works. So the $150 per year goes in for 7 years. All these columns, which we explain in other videos, but here's what I want to touch on. Net cash value. If there's a drawback to a whole life insurance policy, no matter how well it is designed, it's right here. $150,000 goes in, cash value, $130,000 right off the bat. Now, as I continue to look at the policy, by year 5, 150 times 5 is what? $750,000. I have projected $759,000. So it's accumulating over time. By year 5, I've got more money than what I've paid into. Typically, whole life insurance policies have next to nothing right off the bat, and that is primarily because going back to those two areas, my money can go where? The premium or the PUA component. That premium does not show up in cash value the first and second year. Now there's a term rider here, there's a PUA fees as well, which is why I see $20,000 of my $150 not show up. We've got other content that goes into detail on that. But that does not show up in the first and second year. So the question is, to minimize expenses, how do I drive that as low as possible, which is in this example 10%, and plow everything else into PUAs to hypergrow the cash value? That's where I see rich upfront equity, early break-even point, and stronger long-term performance as well, especially when looking at actual policies, like you'll see in this video, and guaranteed values. Anytime we look at the guaranteed values of a policy, the lower the premium, the greater the value. So a lot of info there as far as going through the illustration, which is always good to touch on. I don't want to ever brush over that. So the policy growth, as we look at this over time, will net somewhere between the 4 and 5% range. If a whole life insurance policy is with one of the top companies, 4 major mutuals specifically from what I've seen, and then also designed properly with that minimum premium, maximum cash value or PUA allocation, we can expect the actual net internal rate of return to fall somewhere between, call it 3.5% and 5.5%. Why I have such a broad range there is it does depend on our health, how much we're paying in, age, gender. There's factors that can be considered. This particular scenario will fall somewhere between that 4 to 5% range. Projected much stronger, going back to 2016, but rates were different back then. Now, I'll also add, he's actually been doing this. So he's been using his policy heavily for real estate, used that pretty early on, shortly after purchasing the policy. Really, how he viewed it, I still remember this distinctly, having this conversation with him. He looked at the guarantees, and the guaranteed internal rate of return fell between 3 and 3.5%. And he looked at it and says, hey, I'm pretty much banking on the guarantees here. I mean, that's what I'm selling myself on to say, if it does this, am I good with it? Yes. Okay, let's move forward with it. Now, it's done better than that, but from an expectation standpoint, he looked at it saying, I got all this money in the bank that I'm not comfortable with it in the market, real estate, but I only purchase real estate opportunities or invest in them when they're available. So I'm going to look at this high cash value policy, which instead of stockpiling cash in the bank, here it'll actually earn something, safe, liquid, tax-free too. Oh, and if I want to use it for opportunities that come about, I can do that no problem, which we'll touch on as well. So he has been using it. Now he had an older policy with a loan rate of, it was under 3.5%. Now the rate has adjusted since, but with that said, he's been leveraging his policy as a cash value collateral loan, really in order to keep the interest rate low when he uses it for real estate. So let's progress on here. It's a lot of info I just went through there on the actual life insurance. Now let's get back to his planning, because we want to see how the life insurance fits into the plan. So age 65 based on the alternative path, how will that impact him? What I will add here is his investments that will grow to 2.12 million will stay the same because we're not touching those in this example, mainly because the majority of those are in qualified funds at that 7% assumption. The real estate, still he believes he's going to grow that to 4 million. Probably will grow it to more based on the pace he's moving at right now, and that's at the 4% appreciation. What was impacted? The cash. That now is 1.22 million, and where we came up with that specifically is based on what he was going to grow it to, or what he had, going back to the current path, 2.69, but he started out, where is it? So 425. I'm just going to simplify this. He extracted $1,050,000. And this is why in the alternative plan now, by age 65, he'll have $1.22 million. Normally we crunch the math, but this is just cash, so we're gonna not do that. If you're actually working with us and wanted to see this, we would do it. Now, what he also has is a whole life insurance policy, which he looked at for cash value. $1.715 million. What that is based off of, the age 65 cash value. So he funded this, $150,000 per year for 7 years. Now, he can continue to pump money into it, feed the beast if he wants to, because it just continues to compound over time. However, not in this model. Age 65. What's the value? Cash value, 1.714, I rounded up. Death benefit, 4.681. Now, how much value does that provide? Death benefit proceeds are paid out how? Income tax-free. Going back to his current plan, we're going to look at this next on the distribution phase. Without life insurance, again, he builds his net worth up, he'll be fine, almost $9 million. When that is passed to his beneficiaries, so if him and his wife, when they both pass, money goes to the kids, how is that passed? Is it income tax-free? No. Big chunk of it is in qualified money, a little over $2 million. The real estate, that has advantages going to children, especially if it's income producing. There's a lot you can do with that. But at the same time, there's taxes to deal with. The big issue, and then we've seen this and heard a lot of stories here, is not all the kids always want to assume the duties of real estate. Maybe it's managed, maybe it's taken care of for them, but maybe it's not. So that is really a personal decision, or the situation that you're in personally. Is that something that we worry about and say, hey, how can I solve that problem from a legacy planning perspective with a life insurance policy? Because life insurance and real estate, 9 out of 10 people we work with, not 9 out of 10, 7 out of 10 people we work with leverage the cash value component to enhance their real estate portfolio. A lot of damage you can do there. But the death benefit portion definitely plays a lot of leverage from a legacy standpoint, which we can kind of get into here too. But this is without life insurance. Now with life insurance, he's got these assets. So he's got the $2 million in investments, 1.2 in cash, 4 million in real estate, almost another 2 million in cash value. But then this death benefit of 4.7 million, that piece is left completely tax-free. So as we transition into the next piece, let's see exactly how this plays into his retirement model in terms of distribution. This will be fun. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.